How's this?
Is that your Boom, baby. We are
We fixed it.
live. We are live. So my name is Harry Zikos, if you don't know already, 14-year practicing real estate broker in New York City. And I have with us here today, George Diamantakis from Cliffco Mortgage Group.
Hey guys.
George, give us a little introduction and tell the audience and us what you do and what you focus
Sure.
on.
So I am a residential loan officer for 1 to 4 family properties. I do some mixed use and so forth. But my position basically is I deal with clients to secure a loan for their primary, second home, or investment property. And in this crazy market, we're doing the best we can to keep people educated and really get things going.
Fantastic. So tell us, everyone's, in my client list that's buying right now is freaking out. Everyone's wondering what's the story, where are rates going, where's real estate asset valuations going on multifamily, single family, obviously
Right.
the 1 to 4 sector is what you cover. Tell us a little bit about what's the sentiment from your side of the client stack.
Yeah, so I mean, things are going up, and it's a lot of work to combat qualifying for a property when rates are going up. It's not like people are making more money as the rates are going up. So we have to really evaluate things on a future standpoint, right? So if someone comes to me today, I don't qualify them at the market anymore because, we're not in a decreasing market. We're in an increasing market. So I always qualify minimum 0.5%, and I sometimes revisit it if the rates are coming up, so that when someone is qualifying, they're able to get that shock payment. If let's say the rate was 6% yesterday and it goes up to 6.5%, or in our case, 7 to 7.5%. That's a big difference in monthly payment. We're talking about $700 for every 100,000 that we borrow. So, on an average person, not a, multimillionaire who's buying under their means. We're talking about ordinary people purchasing homes for their families to live in. We really need to qualify them higher than what we're really looking at, because in a rising market where, let's say, rates are coming up and values are starting to creep down, it doesn't scare me in retrospect to where the markets will go in the future, because when you're at the top for the interest rates, there's only one way they can go, and that's down. So, where is the end? We're not really sure. I think the rates are going to near 8%, maybe go above, hopefully not, but they're only going to come down. But, as you're in real estate, values may come down a little bit right now, but where are they going? They're going to go up. So we're positioning our clients to secure a property that's good for them, with hopeful ideas in the future that we can refinance them and save them a ton of money.
That's awesome to hear. So it seems that the sentiment is that the Federal Reserve is not going to do the Fed pivot that a lot of people are talking about, with expectations of another FOMC meeting. We're probably going to see them increase the Fed funds rate probably by another 75 basis points. I think they're meeting in November, or is it mid-October?
Not exactly sure, but they did confirm another rate hike. So a lot of people hear that and they don't know what it means, right? So I don't know if anyone remembers back in 2020 when COVID kicked off. What it was, maybe about a month after that, they were like, the rate's going to 0%. People were calling me, asking me, is the rate 0%? And I'm like, no, it's not 0%. They want the Fed fund rate to get to 0%. The Fed fund rate is where banks trade at, right? So the cheaper the Fed fund rate, yes, the less the interest rate will be. So when they dropped it close to, I think it was 0.25%, our rates were in the 2s. But as that started to creep up, now the Fed fund rate is between 3 and 3.25. That completely changed the way we trade on the interest rate platform, and we're around 7.25, whatever it is, depending on the person. So the Fed fund rate, when it's trading so high, there's a lot less urgency to lend it, and that's why the rates are going higher. So when the Fed fund is lower, they want to trade more money and keep it going. But the notion is the more expensive it is, the less they're going to want to trade that and let it adversely it goes into people buying homes with their interest rates on their homes, and those numbers go up because of it, because there's less demand to borrow.
Yeah, I think the Fed demand destruction strategy is definitely underway, and I think there's a strong probability we're going to see the beautiful micro and macroeconomic lessons take effect. Right, if there is an imbalance between supply and demand, usually, if there's too much demand, the price goes too high, and if there's not enough demand, well, the price naturally has to come down to an equilibrium.
Right.
And now that the cost of capital has well over doubled, I would say about 2.5, 2.5x of where they were just a year and a half ago. I mean, my sister bought a house. She paid 2.6% on her interest rate 30-year fix. I mean, she's off to the races and she's singing and dancing and feeling like she's the richest person on the planet, while inflation's at 8%, 9% aggregate.
Maybe more.
Who knows what is actually being reported, right? So, I mean, talk about a good way to hedge against inflation is to take cheap fixed interest rate debt, but that party's over and that ship has sailed. So, it's like, how do we as brokers, mortgage professionals, real estate brokers, salespeople, appraisers and alike, anyone in the real estate investor community, how do we navigate accordingly? I mean, everyone's afraid of some sort of great recession and everything like that. But I honestly think that we're in the midst of the recession. They redefined what the recession meant. So that's a whole other conversation. But are people still getting mortgages? Are people still borrowing? Or is it all prior contracts that were signed and they're just, biting the bullet thinking they can refinance?
Most of the people, yes. And I'm definitely seeing transactions still happening. Values are kicking down, but our appraisals are coming in at ask and higher. We're in a funny market right now because you're going to have a transition into a buyer's market, which is something that is extremely rare. And in a lot of people in our lifetimes, we haven't seen them. So I don't know if it'll technically be a buyer's market, but there's going to be a lot less demand for the standard buyer to buy something. And you're going to see a lot of people who maybe couldn't get an accepted offer or couldn't, go forward with a house. You're going to see them step up and still purchase with the notion that down the line, they're going to refinance. Now, the rates got into the 7s this week, right? Mm-hmm. I got a ton of phone calls asking about ARM products, asking about first-time homebuyer Sony May products. My Sony May product is at 5.75 right now.
Let's go into that a little bit. Let's talk to the audience. Maybe some people, who are watching live or who don't know about this. So go into what an ARM is, and then go into these variable interest rate products that still exist today.
Sure. So I never pitched an ARM product to anyone because when the rates are so cheap, what's the point? But with an increasing rate market, the ARMs are adjustable rate mortgages, but they're fixed for the first certain amount of period, whichever option you choose. It could be 3-year, 5-year, 7-year, and 10-year. Most people go for 5, 7, or 10-year fixed. And they're great if the rates are really high on the standard 30-year conventional, and you're able to capture, I don't know, whatever it is, a rate in the 5s on an ARM product, with the notion down the line, you're either going to sell or refinance. If you're looking to stay in that product forever, it's not a beautiful idea, because if the rates keep going up, like we don't know about, what happens then? Your rate's gonna go up when it adjusts. So what it means is, if you take a 5-year ARM product, you're fixed for 5 years, and then there is the ability for the market to, if it gets worse, your rate will at the 5-year mark adjust up. And for everyone that's purchasing, we know that we don't want the numbers to go up. We want them to go down. So, like, let's say you buy a home and it's your starter home, and you're like, you know what? I'm going to be here 5 years. I'm not taking a 5-year ARM if I'm thinking about staying there for 5 years. I'm going to take a 7-year or a 10-year ARM, because when people buy homes, they don't realize that life happens and things come up. And even if you do sell within 5 years, you don't want to risk that ARM adjusting and going up. If the rates will probably be lower, but I mean, who knows? I mean, this is an unpredictable market we're in currently. Hopefully it stabilizes down the line, but an ARM product should secure you for a certain amount of period longer than you actually want to be in that loan. Mm-hmm. And I think they're great right now if you have the idea to refinance at a later time or sell your starter home and upgrade into a bigger home or downsize, whatever you're looking to do. But if you are looking for an out after a certain amount of period, an ARM product is a really good option.
That's very interesting. I definitely coach my first-time homebuyer clientele that, generally speaking, their first acquisition on a home is never their forever home. It's usually a stepping stone. I typically see like a hold period of anywhere from 4 to 7 years as a general average, at least within New York City standards. Granted, if you're in more of a suburban area and you have longer, attachment to a school district or what have you, that's a whole other conversation. Right. I guess it comes down to the buyer and the client's interests and speculation on what the Fed's policies will do into the future. And if they think this is going to be a short-term storm of fighting inflation, then maybe you take the gamble and you bite the bullet and you say, all right, well, we'll do the, a 5 to 7 or 10 year locked in ARM, but we save, 2 points on the rate. Maybe it makes sense, but I guess that's the question: is the buyer going to have to make that wager, maybe almost Pascal's wager, right? If they want to play that game, because ultimately you can't really fight the Fed, but it's basically absolutely speculative, right?
Yeah, absolutely. So it's definitely a good approach because one thing is you don't want to be cornered to do something you don't want to do. So definitely, it's a thought process on if this is for you. It's not for everyone, but for someone who maybe is going to be earning more and more and more each year, that's an option. Sometimes when you have a lower income, let's say, not saying low income, but a lower income, and you don't have the growth that some individuals have, sometimes the ARM is not for them strictly because they like security. But I definitely like an ARM product right now. Mm-hmm. For a longer period ARM product, not a short ARM product. Even though I believe personally that the rates will turn around sooner than people are expecting, I still want security. So the further I can get from where I believe they're going to be, I mean, so each ARM tier, a 3-year is going to have a better rate than the 5-year, as opposed to a 7-year and a 10-year. But how much different is it? Maybe 0.25% to 0.5% between all the products. Mm-hmm. It's worth it to get the security of those extra years.
Mm-hmm. Generally, are borrowers having to pay like commissions or paying points on getting this type of financing structure, or how does that?
The ARM products definitely require maybe a point buy down, but what you're seeing now with the rates on 30-year conventional loans, you're seeing people pay where we weren't paying anything for years. It was insane. The way I was coaching people is, why would you pay to lower your rate when it is already so low? And now they're probably thanking me because now people are paying to lower their rate because it saves them that much monthly. And it brings you back towards that ARM product. Why would I pay 7% when I can pay 5.5% or 5.25% on an ARM and get that security? It's a big difference in payment.
What's the typical loan? I mean, we're definitely getting into the weeds on the industry language, but what's the typical LTV or loan to value, lending standards within underwriting departments at a bank, compared to a fixed loan or conforming or jumbo versus, let's say, I mean, I'm obviously asking a lot of questions in one question, but fixed loans versus ARM, what type of underwriting requirements are there? What type of standards? What type of loan to value?
Sure.
Are appraisals coming in lower from the underwriting team? Tell me what you're seeing, because you're on the boots in the ground in the lending space, and it's ultimately guys like you that are involved in the money printing process. So I want to know about it.
So conforming versus high balance versus jumbo, right? There's a few things that you have to think about. Mm-hmm. These numbers every year for many years have been increasing. So when I got into the industry, you were looking at a $400,000 conforming loan limit, something around that sort. and now we're going into the 700s. So what that means is the conforming loan limit is our standard conventional, and FHA applies, but more so conventional. I'm going to talk about loans that are standard and basic in regarding to underwriting and pricing. So your best deal is on a conforming loan, and the limit is going to change into the 700s in January. But on my end, I have a couple investors that already opened up the product. So before it was 640, now it's going to be, I think, 760 or so on a conforming loan, which means you can buy a single family property in the high 700s and put the minimum down as long as you meet that requirement in the conforming loan. The minute you go above that, you can still do it, but the minimum down on a conventional loan is 3%, which is insane.
FHA, if I'm not mistaken, yeah?
No, conventional has opened it up. So really? Conventional 3% down up to 760. I forget the new loan limit, but it's up to about 760. So you also have to qualify for it, keep in mind. So I mean, does everyone qualify for it? No, but the minute you step above that, the minimum goes to 5%, and our underwriting is the same until you hit jumbo loans. The jumbo loans are a lot more strict. And it is what it is. That the jumbo loan obviously is not for everyone.
What's that threshold that goes from conforming to jumbo, generally speaking?
So the jumbo limit now is 960, and it's going to go up in January, already confirmed. But
loan amount.
Yeah, the loan amount, the minimum loan amount. What that means is a jumbo loan, for the most part, I've done them with less of a down payment. I've done them at 10% down. I've done them at 15% down. But where the loan limits are going, it doesn't really work because a lot of the investors wanted them under $1 million. But now the loan limit is soon to be over $1 million. A jumbo loan typically requires about 20% down. Wow. Whereas a non-jumbo loan, you can go less, 3 or 5% down. And look, in a market like this, I mean, you could do a couple things with your money. I mean, we all know the standard route would be save it, renovate, do this, that. People are paying points now. They're using that extra money. They maybe put a little bit less down to buy down their interest rate with the money they would be using as a down payment, and they're dropping their monthly payment a little bit based on, buying their rate down. So something to think about too.
So what markets are you covering these days? I know you're not just in the New York market. Tell the audience and me where you're licensed and where you practice in all your loan products.
Sure. So New York, New Jersey, PA, Connecticut, Florida are all the states that I'm licensed in, but my company is also in Texas, the Carolinas, Virginia, and we're working on a few more. But the majority of our business, believe it or not, even though we're licensed in a bunch of states, is New York, New Jersey, Connecticut, and Florida a lot, because a lot of these states snowbirds and then they go down to Florida. So you do see a lot of people going down to Florida and purchasing. I had a lot of clients the interest rate market kind of swayed the way people are purchasing now. So I haven't seen a lot of Florida deals recently, but before the rates, went above 6%, I mean, I couldn't tell you how many Florida loans I've been doing.
Wow. So it doesn't seem that, despite a lot of the fear, I mean, obviously a lot of buyer demand probably in like the sub 700K purchase price territory is very skittish, but the wealthier buyers are not necessarily afraid. And it seems that they're a little bit more financially educated and literate, and they know how to play the game. And they know that ultimately the United States cannot afford to keep such an expensive Fed funds rate and pay such a high dividend on their treasuries when we have 30 trillion in outstanding debt. So I think that may be like the Fed put, so to speak, in a way. Like there's some definite speculation, I feel.
Absolutely.
Yeah, that's awesome.
I like that you brought it up, because a lot of the higher income tends to be self-employed. They're not, not everyone is a W-2 earner making $1 million. I mean, they're out there, but it's rare. Mm-hmm. So you tend to see a self-employed borrower, and we have a huge array of products that cater to them. And it's allowing now self-employed people that maybe their company can make a few $1 million on the books or less. I mean, I've seen it all, but they claim not so much on their tax return. we have products that use alternative income in order to qualify them and get them in these properties in times like this. So the regular fixed rate is high. If you pay a little higher and do an alternative income product, they're called non-QM products. And I use a 12-month business bank statement to derive income, or a P&L product with bank statements to verify that, or just a P&L product from the CPA. You know, the CPAs are backing these products because they know the businesses are making money and the client's making money. But obviously, they do what they do to save their money their clients the most money on their tax returns. So, you know, maybe the bottom line of the business is not showing what the person's actually making because they want to save them money. Mm-hmm. So they depreciate a lot of that income, and it's usable in regards to our mortgages, but it's sometimes not enough. So there are other ways that we can derive income from a business owner in order to qualify them on these houses. And all these $1 million houses and up, the values for sure are going to drop faster than, you know, an affordable house, which is affordable back in the day was maybe 400 or 500 grand. Right. Now it's 700-800 grand or 600, you know, in that range. Mm-hmm. The numbers have changed obviously upward. So those affordable homes, they may hold value a little better, but you know, $1 million and up, you're going to start those to see those drop a little bit. And it's going to give an opportunity for self-employed borrowers to get in there and purchase with these alternative income products.
Interesting.
So, and then again, you can always refi out if it's a little different because a business owner is used to seeing expenses. So when they see a high interest rate, they're not as scared to move forward on a transaction mm-hmm. because they know that it's part of it. It is what it is. Look, high interest rates scare me, and I'm in the business. Yeah, you know, I want to give the best deal to everyone, but you know, it doesn't let me do that right now with the market the way it is. But we have to fit people in to the right product that suits them, and if they're willing to move forward, that's their choice. It's not mine. We just have the capability to do things for them.
Fantastic.
So yeah, these self-employed borrowers are going to have a big opportunity to get into the market and purchase what they always wanted to purchase that maybe couldn't because, you know, they didn't claim the money on their tax returns.
Yeah, I definitely think we're also entering into the era of the buyer's market, at least for the next probable anywhere from like the next 3 to 18 months is going to be times Absolutely. Where there's going to be high fear in the market. And like Mr. Warren Buffett always says, shout out to his geriatric practice, but it makes sense. You know, you got to be greedy when others are fearful and fearful when others are greedy. I love that quote, and it makes sense. You know, the cost of capital is not necessarily the only thing to, you know, pry on if a property makes sense for you. If you're buying something like a 4-family, maybe you're living in the other unit, or you're house hacking and you're playing the property a little bit more than just a place to live in. You know, you're getting more than just the equity pay down. You know, you might not be getting the appreciation immediately, but that you still get, you know, you get cash flow on the rents. Your sustainability of the home is easier if you're getting a 4-unit or a 3-unit. And right now, I'll tell you what I see on my desk, George. Mm-hmm. Rental market is on fire.
Absolutely.
There is not enough rental product anywhere.
Absolutely.
I'm breaking records for landlords that I represent for any product that is not rent controlled or rent stabilized, rather, because rent controlled is dead for the most part. And people can't get enough of it. So there's so much fear that everyone's going into more short-term housing, 1-year, 2-year leases, and they're desperate to pay 15% over year-over-year increases. So
absolutely.
I mean, that's also going to push people back into the buying pool, I think, because if your rent increased 30% like it did in Miami, well, hell, if you're paying $4,000 for a 1-bedroom in Brickell, maybe you buy one for $500,000 and you work out the numbers and it still might make sense. All things to consider, you know, but hashtag not financial advice, you know, all the disclaimers here. But let's see what we have somebody in the chat here saying something interesting. Let's see what he says. People don't want to rent out because of various moratoriums. Well, those are pretty much gone, Mr. Berkey, Rafferty. I'll tell you, they are changing. I mean, New York certainly has like a lot of backlogs on their tenant landlord court proceedings. But, you know, states like Florida, states like the Carolinas have a much more expedited process. Let's see what he's saying here. My mother and grandmother are both dealing with terrible renters. Well, I wish you hired me as your landlord rep if I'm in your state, man. What can I tell you? But ultimately, you know, you're at the mercy of the state and municipality that you own your buildings in. And that's why you have to wait for the right tenant, pick the right tenant, price right, offer the right product, renovate to attract the highest quality people. And of course, the 3 L's, baby: location, location, location. Awesome. So George, I know you're a busy guy. You got to get going in a little bit. Where can people find you and, plug your stuff?
So yeah, I mean, you can find me on Instagram at George Diamantakis. That's just my full name. I'm not hiding from anyone.
We're doxing him, guys. That's it. He's out there in the open.
It's private, but I'll accept you. There's a link to my website there. Yeah, if that's the best place. It'll basically guide you to everything that I do. You can Google me. I'm going to come up first. My link will come up right away. There's not many George Diamantakis there. So you're definitely going to see me at the top of the list. I have a couple other videos there you can check out too. Kind of from a month or two ago, explaining. It was funny because, a month or two ago, I was talking about 6%. Now we're talking about 7%. And it has changed a little bit because the market from 6 to 7, I'm glad we really spoke about ARM products because the market from 6 to 7 has really put people into 3%. Love that. You and many other people. A lot of my friends, I refinanced in the low 3s, in the 2s. I did a couple at 2.375 with no points.
Oh.
I did an investment property back in the day. It was an investment property, 2.375 with 2 points.
Oh my God.
It was the guy's laughing right now where things went. If you try to do an investment property now, you're going to be in the high 7s with multiple points. And that's only because they don't like to price those loans without points. And I would love to price it out without points, but without points, I mean, where would it go? And who knows? They don't even let us price it without points. Wow. That's how investment properties are working right now. So they're gearing strictly towards primary resident holders. And that's where the market is right now, primary residents. But if you're able to and you can afford it, you might be able to scoop up a good deal with Harry soon. Yeah. 3 to 18 months, we think.
I think so, man. We're entering into the era of the buyer market, in my humble opinion. But of course, none of this is any kind of. We're not telling you what to do with your money. Consult your advisors. Everything is very location and sub-market driven, guys. We're just adding to the body knowledge that's out there on the internet in this conversation. And George is a mortgage professional for, I don't know, it's been like what? How long you been in this game? 12 years, something like that?
Yeah, around there. A little over 11.
Wow.
So,
wow. Amazing.
There's people that are out there a lot longer, but I'll tell you one thing. I mean, you have to really like who you're working with. So if you can find someone that's really, really on your page, hopefully that's me. It's going to save you a lot of time and effort,
100%. Well, a lot of my network is in a lot of different states, but a lot of them are, in Florida and some are in the Carolinas, a lot in New York, of course, as you know. So I'm definitely going to, throw all your contact details in the description once this live is over, and people hopefully find you. And I want to bring you back, and maybe we do every 3-4 weeks we do a market update, because this is such a time where everything is so dynamic, everything's changing. This stream might be outdated. The rates may go to 8.5%, 9%. God forbid.
Hopefully not. That's scary.
It's frightening. There's going to be a freeze if that happens, but we'll see. Yep. And anyone who doesn't remember, my name is Harry Zikos, real estate broker in New York City, and we're going to sign off for now. But you'll see us again. Thanks so much for watching, and peace out.
Thank you.